Hello everyone, welcome back. I hope you can hear me. This is a Black Box. So today in this live stream we'll be using the Black Box concept with ICTs. Break of structure, change of character, and some of these other concepts too, right? So I hope this is episode 1. We should be able to learn some things, right? And I believe we would be learning a lot of things. So the first thing we need to do is, as always, we need to define our black box. We need to identify our black box. Then after that, we need to use that black box for a projection, right? For a projection for TP2, and that's our TP, that's TP2. So I was looking at this black box right here. This one, this last bearish candle, the red candle, and then the next bullish candle, and then the third bullish candle that broke and closed above the opening of this bearish candle, right? The last bearish candle. So how do you project it? How do you identify black box? So if you have been following me, so you already know what a black box is. So black box means it is just 3 candles consolidation in a row, right? So this one is a black box right here. This one up there, this bearish candle, this doji gravestone, right, and then this bullish candle. So this makes a black box. This is an overlapped 3 candles. That's what we want, right? That's a black box. And let me show you another one right here. This one's another black box. We can trade based off of this one, right? Then we would be zooming into the lower time frame. This is a 1 minute chart, as you can see right here. This is a 1 minute chart. Brent oil is on OTC. It is on OTC, right? So the other black box is right here. One, this bearish candle right here, the big one, then the bullish doji, and then the bearish doji. This makes a black box. So inside of that black box we would see a fractal, a price fractal. Inside that fractal you would see your entry, right? But your TP is projected on the higher time frames, like the 1 minute. Okay, so this is for learning purpose. So everything we do here can be applied on the higher time frames, like if you are trading on the 1 hour, or if you are trading on the 15 minute, 2 hour, 4 hour, daily. If you are a swing trader on the weekly time frame, it works on all time frames. It is universal. Why? Because price is fractal, right? So a player who is a swing trader on the higher time frames has the same opportunity as a scalper who is trading on the 5 minutes time frame. They both have their own objectives. What differs is the time that they hold their assets, they hold their shares, right? For how long they hold it. That's the time. So the black box is one I showed you here. So refreshing, I'm just refreshing the concept. Another black box here, where 0, the last bearish candle, this one. I mean, these are all consecutive bearish candles, right? But the last one had an overlap with a bullish gravestone or doji. Then the third candle traded overlapped with the two of them. That makes that the black box, okay? So inside of that, after the three candles have been formed, we need to use a Fibonacci, okay, to determine our TP. Everybody uses a Fibonacci, everybody. So right here, leg, how do we measure it? From the bodies to the body, the highest body. From the three candles, which candle has the highest, the longest body? So in this case, this is this bearish candle. So I am using the largest bearish candle. So then TP2 is where? Let me use a horizontal line here. TP2 is up there. That is the final destination for this black box down there. The final destination is that one, this price level. And behold, what did the price do? It bumped, it hit that TP2 and then collapsed. Look at that. That's the best place. It is not the highest most place to get out, but that's the best place. Right? If you have a liquidity like a swing high or double tops or double bottoms, so as you can see, we are incorporating ICT concepts too. You can use that swing as a target, but the TP2 is most prominent. It is the most important TP that you need to watch. You need to be careful. Alright, right here we had no swing highs or lows here. Okay, let me show you. Right, in this bearish run to the downside, there is no swing high. Right, what is a swing high? A swing high is basically just head and shoulders. It is simple. It's just head and shoulders. How do we identify swing high? So these smooth tops do not qualify as a swing high, but they can be qualified as a double top. On the lower time frames, these two tops, smooth tops, had two equal highs. Right, on the lower time frame, I can show you on the 5 second, 15 seconds time frame. Okay, no worries. A swing high is this one, this bearish candle. Why? Because it has a higher low on the left and a higher low on the right there. Right? So this is basically head and shoulders, okay? There is a shoulder on both sides of the middle candle. So if the middle candle is lower than the two shoulders, that makes a swing high. On the counterpart, we have, a swing low, I'm sorry, this is a swing low, this is a swing high. Why? There is a lower high on the left shoulder and there is a lower high on the right shoulder, right there, as you can see it. So that makes this a swing high. Why is this important? It is because it is used as a target for institutions, a target for big traders, whales. There is a pool of liquidity here, a pool of sellers. Buy stops. There are buy stops here. Sellers who think the price is going down, sold right there, around there. Then put their stop above that high. They sold inside of that price fractal. They put their stop above the swing high. They think that that's resistance, okay? So after they put that, so everyone is selling, the retails and hedge funds. Some hedge funds could use a swing loss to put their stop loss. When that stop loss accumulates, there are a lot of sell stops. I mean, a lot of stop losses, right? Stop losses. So those stop losses are money. Okay? They are money. When price comes back up, the sellers are losing. Why? Because they betted that the price is going down. But when the price returns back up, they are losing money. When the price hits their stop loss, they will be out of the game, right? There will be no more sellers, only buyers. So the informed traders who bought down there because of this liquidity hunt down there now target the swing highs. In the first place, they engineered this swing high, right? By taking out these smooth stops. So every swing high and low is a calculated move. It is a calculated move. As you can see, look at that. That's a smooth stop. Smooth. They didn't take out the high, it is equal. What does that say? That says that they are luring, inviting sellers to enter the market. Inviting sellers. As you can see, there might not be a lot of people participating in the 1 minute time frame, but as price is fractal, you could see this on the higher time frames, to the 4 hour time frame, the 15 minutes, the 1 hour, the 2 hours, the daily, and the weekly, of course the monthly too. You could see these kind of structures, right? So what's happening on the higher time frame could happen in the lower time frames too. Otherwise it could be a mess. A price would be a mess. It would be random, all random. There is unpredictability here. So they make a swing high, equal highs, selling the idea for the sellers that this is a strong resistance. So the sellers now rush in and enter a sell. When? Right there at that run to the upside, or a rejection after the rejection, at that retest. Which retest? This one. So this candle retested the upside, the enter a sell, right? The enter a sell. They put their stop up there. So what did the price do? It went straight to that buy stop, to that stop loss. Look at that. After that, what did they do? They distributed the downside. They took out the lows down there. They engineered before. So they were eating everyone's money. Otherwise their orders won't be executed. Why? Because trading is a zero-sum game. If there is a buyer, there has to be a seller. If no one is selling to the buyer, then the price won't move. I mean, the price could move. The algorithm still moves, but it won't be executed. Their orders, their buy orders won't be executed. Why? Because there is no counterpart. As you know, the forex market trades trillions of dollars a day, right? 6 trillion, 7 trillion dollars a day. So a lot of banks participate in that trading endeavor. So that is called liquidity. Liquidity means there is almost equal amounts of buyers and sellers, right? There is sufficient buyers and sellers in the market. So if someone wants to buy euro dollar at 1.66 level, then it can buy at that level. Why? Because there is a seller who wants to sell at that level. There is a seller, there is a liquidity. So if there is no seller, the price, the buyers won't be interested. If there is no buyers, the sellers won't be able to execute their trades. So which means this hand here is for the sellers to execute the trades to the downside. This hand right there. This hand, the smooth stops, when all the sellers are out.